Senator Menendez.
Thank you. Chairman Yellen, thank you for your leadership at the Federal Reserve. Our economy, though not perfect, has made tremendous strides since the financial crisis and ensuing Great Recession, which wiped out nearly $13 trillion in household wealth and cost 9 million Americans their jobs. And I think these last 6 years have shown us how important and positive Wall Street reform and consumer protection has been to our economy, to strong markets, and most importantly to American families and businesses. Now, I want to ask you specifically, as you know, health care accounts for nearly 20% of U.S. GDP, including not only the delivery of life-saving, life-enhancing health services, but also fueling innovations in patient care, in diagnostics, in preventative health, and research and development of cures to diseases. In response to the FY17 budget resolution that Congress passed last month, the former director of the Office of Management and Budget sent a letter to Congress saying that the resolution would add $9.5 trillion to the deficit. Recent studies have shown that a major market disruption would have a detrimental impact on the labor market, including a reduction in job growth by nearly 2.6 million jobs in 2019. My home state of New Jersey is estimated to be among the top of the list when it comes to potential job losses as a result of a spike in the number of uninsured. Furthermore, stripping nearly 30 million people of their health insurance would have a significant impact on the productivity of the American workforce. Are you concerned about how this major increase in debt, coupled with downturn in the labor market and decreased productivity, would have on the larger economy?
Well, we would have to look at what the impact is of shifts in health care on the economic outlook. Health care, as you mentioned, does account for a very significant share of spending, and a loss of access to health insurance could have a significant impact on spending of households for other goods and services, and beyond health care itself, have impacts on the economy. In addition, access to health care has, for some individuals, likely increased their mobility and diminished the phenomenon called job lock, where people are afraid to leave jobs because of losing health insurance, and that could have implications for the labor market as well that we would try to evaluate.
So we should tread lightly before we make major changes that create disruptions. Let me ask you this. In the years leading up to the financial crisis, many lenders and financial institutions exploited the uncoordinated enforcement of consumer protection laws and misled consumers into expensive and risky subprime mortgages, even if they qualified for prime rates. As part of the landmark Wall Street Reform and Consumer Protection Act, we were finally able to empower a cop on the beat to protect hardworking Americans from unfair, deceptive, and abusive financial practices. And from my view, it's been working. As an independent agency whose sole job is to enforce consumer protection laws, the CFPB has returned almost $12 billion in relief to more than 29 million consumers. And more importantly, the Bureau has helped level the playing field for hardworking American families, ensuring that consumers are protected when they purchase a home, open credit cards, take out student loans, and use prepaid cards. Do you believe that if an independent consumer-focused agency like the CFPB had existed to police mortgage markets prior to the financial crisis, that much of the economic damage to working-class families would have been avoided? In addition to protecting individual families, would better enforcement of consumer protections also have enhanced national financial stability?
Well, I do agree that consumer abuses in the mortgage and securitization areas played a key role in the crisis. The Federal Reserve at that time had responsibility for enforcement of these regulations, and in retrospect, I wish the Fed had acted more aggressively and earlier to address those abuses. We've certainly learned from the financial crisis that it's critical to monitor this area and the potential for deceptive practices in consumer lending to create a financial crisis or financial stability issues.
So an entity like the Consumer Financial Protection Bureau, which has in essence done that since the Great Recession, has played a critical role in ensuring that. Certainly, I agree that had the Fed been more active, along with all our other regulators, about being the cop on the beat instead of being asleep at the switch, it would have been great. But in the absence of that, a bureau like the Consumer Financial Protection Bureau is actually playing a significant role in ensuring that consumers have a level playing field. Was that not a fair statement?
Well, they have been focusing certainly on these issues.
And let me close by saying in the 104-year history of the Federal Reserve, it has had 134 different presidents of regional banks. Not one of those 134 presidents has been African American or Latino. That's pretty outrageous. And it is my hope that now that there are some openings, that we begin to change that reality. These are two communities that have an enormous part of contributing to the nation's GDP. And for them not to have any representation whatsoever in the process of these banks is not acceptable. And I hope we can begin to change the reality.
Increasing diversity is a critical priority, and I share your hope.